All right, guys, I want to welcome you to our Friday night wealth creation course, Finance Friday, as we like to call it. We're here live on Facebook, on Zoom. We're going to replay this on YouTube. We'll put this out on our channel as well. Let me go ahead and turn my volume off on my computer. But guys, I want to welcome you. If you've just joined us for the first time, congratulations. This is a Friday night. If you're investing your time to learn about finances, that is a big deal. So I'm Jerry. I'm the owner and founder of a company called Wealth Dynamics. And what we do is we help families and individuals become financially independent. We help them learn the truth about money. We help them, learn how to earn income, save income, and then take that and then generate more income through investing. And so one of the topics that we're covering tonight is that topic of saving. Okay. And there's a lot of false data, false information out there about saving. One of those being savers are losers, cash is trash, all of these things we hear. And I'm going to talk tonight a little bit about that, but I want to talk about where I save my money. And I'm going to share some of the differences and compare and contrast why I use each of them and what I use each of them for. Now, to give you a little bit of my backstory, again, I'm a company called Wealth Dynamics, and we do a lot of what I consider, it's called alternative finance, but it's really traditional. Right. So all the stuff that we do, it's pre-Wall Street, it's pre the banking system. It's actually the stuff that the top 1% have used for literally hundreds of years to build wealth. And if you look through history, in the early 1900s, we really had the banking system take over as we know it today. Mid to early 1900s, we had Wall Street take over. And then we get into the late 1900s, Wall Street has taken over even more. And we have things like the 401k and the mutual fund, all the stuff that people put their money into, but none of it is actually used by the wealthy. And so my background was initially a financial advisor. Okay, I had, all of my investment licenses, state and federal. And so I would sit down with people and I would share with them, what to do with their finances. And a lot of it was, put your money with Wall Street, put it in the bank, put it in stocks, put it in all these different financial instruments, right? And so when I started to really learn about money, and I talk about this story a lot, but I want to share it with you guys. I used to go on, when I first got into the industry, I used to go on these appointments. They were called field training appointments. Okay, and a field training appointment means that my mentor, my manager, he took me out with somebody that was, maybe a friend or a family member, and I would do, my demo presentation with them. They would kind of guinea pig, and I would, show them my products and services, and then hopefully they would sign up and buy some. Right. So I'm on one of these field training appointments, and I was with, a very close friend of mine. I was with his dad. Okay. And I sat down with his dad and I'm going over and showing him this different financial product and how it works. And I went over it. And then when I got done, I was like, man, there's no way this guy's not going to do business with me. I've known his son since we were middle school. We're best friends. I go to their house every week. He's got to buy something. And I get done with this presentation, and this guy takes my little folder. I was presenting on a folder. He takes my little folder and he turns it around. He says, hey, I want to explain back to you what I just heard. Okay. And so he starts explaining to me the product I just showed him, but he explained it in a way that was more simple, right? More concise. And when he explained it, it actually didn't sound like a good idea to me anymore. And I was the one selling it. Okay. And that was my first taste of dealing with somebody that was actually financially independent. I didn't know this at the time, but this guy, my buddy's dad, he was financially free. He had real estate and passive income and rental properties and private mortgages and all of these things paying him every month to where he didn't actually have to work anymore. Okay. And so he was looking at me and saying, hey, I don't save money with Wall Street. I don't save money in these products. I don't save money with the banking system. And so that was like at 19, 20 years old, right? And if you fast forward, 3, 4, 5 years, I start learning about it myself, right? Who remembers 2008, right? 2008 happens. I was in 10th grade, so I didn't experience 2008 myself, but several years later, this movie came out called The Big Short. And I watched The Big Short. I actually read the book because my buddy had been telling me about it forever. And when I watched that movie, I really walked away from it at the end. If you've ever seen it, there's this clip at the end where the actor Ryan Reynolds, he plays the broker. Oh, Ryan Gosling, same thing. He plays the broker, and the broker is the one pitching the deal to everybody, right? He's the one saying, I've got this stock, you should buy it. I've got this deal, you should get into it. And everyone loses their money but him. And the reason why is he didn't actually own any of the things he was selling. he was just pitching it for a commission. He was trying to make money off of his clients, and he did. And so at the end of the movie, he's like, hey, I didn't lose any money. Do you really think I owned this stuff? Right. And so at that time, I was a broker. A financial advisor is a broker. I was selling products for commission, right? I actually did own what I was selling, but I didn't actually know as much as I thought I did about it. And so I went through this period of relearning finances. I was like, okay, where, if we don't put it into this stuff, should we be putting into our money? If we shouldn't be giving it to Wall Street, if we shouldn't be giving it to the banks, where should we be putting it? And I started to do some research back, and I want to kind of sketch this out for you so you have a visual. As I started to learn about this, I started seeing, all right, so the average person, and I was guilty of this too, the average person takes their work, right? So we take work and we take value. We're going to call this value or production, right? And we trade this for US dollars. Okay. This little cycle here, this is called earning. And I know this sounds very simple, but we're going to go somewhere with this. We take our dollars that we've earned and we mistakenly call it money. Okay, the US dollar is not money. Okay, there's something called currency and there's something called money. There's actually a vast difference between the two. I wasn't even taught this as a financial advisor, right? I thought money was money. I thought I earned dollars and that's money, and I keep money and I save the money and I invest the money. And little did I know, it's not even called money, it's called currency. And this is one of those things, once you learn it, this will become a little game of catching yourself when you start calling dollars money, because they're not, right? So what is the difference between currency and money? This is where we have to start, and this is where I had to start, okay? Currency is a medium of exchange. I've talked about this before. Back in the day, we used to barter, right? If I had a farm and you had, let's say, a blacksmith shop, and I wanted your stuff and you wanted my stuff, we would trade. Okay, and it's called the coincidence of needs. You had to happen to want something that I had, and then we traded for it, or vice versa. Right, so that was called bartering. And so when you start introducing more parties into the bartering, it actually becomes more complex and confusing. Let's say that 3 or 4 or 5 of us now have different products and services, and I want what you have, but let's say you don't want what I have and you want instead what the 3rd or the 4th person has, and then I've got to figure out how to get what they've got so that I can get you what you want so I can get what I want. And so that was very inconvenient. As you can see, there's a lot of back and forth and roundabouts there. So this thing was established called currency. Okay, basically coupons, right? Instead of trading chicken for metal, right, we're going to say, okay, let's have a coupon. Let's have something in the middle that we can all agree on is valuable. And if we can all agree that this thing is valuable, then everyone accepts the coupon, and it's redeemable between all of us for whatever product or service we want. So whether it's milk or bread or metal or whatever it might be, we all agree to accept the coupon. And so I don't have to go chasing around to get the things for you to me to get the thing that I want, right? So this is called currency, and currency is a medium of exchange. Okay, it's basically it's a terminal. We send things back and forth on it. It's a channel, right? So I send value from me to you on currency. You send value from you to me on currency, and that is earning income. Earning income is the act of us exchanging value and then having that value represented by currency, whether that's paper or digits. Now the question becomes, what do we do when we get the currency? Okay, because I grew up broke. I grew up, on food stamps, food bank, free lunches. My my parents, we couldn't even say we were paycheck to paycheck because we couldn't even get to that point of like being okay until the very next paycheck. Right, we were in the deficit from the get-go. So I didn't even have the experience of we're earning lots of money. And so what happened for me is, as I got into business, as I became an entrepreneur and learned how to sell and earn income and currency, I was then posed with the question of, well, what do I do with it? Okay. And traditionally what people do with it is they keep it, right? We get the dollars and then we earn the dollar, right? And then we save the dollar. And then we actually invest in the dollar. A lot of people invest in dollar denominated assets. And I want to talk about what that means. In math, there's this thing called the nominator, and there's this thing called the denominator, right? Who remembers this? This is basic arithmetic, right? So the nominator, right, is let's say we're doing a division problem. Let's say that we're doing 100 divided by 5, right? So what we're asking is we're saying, okay, this is the numerator, right? Or the nominator. Numerator, I think, is the correct term. Then we have the denominator. So we're saying, how many times does 5 go into 100? It goes into 100 20 times, okay? And so when we take an asset, the numerator, we're dividing it by dollars. We're saying how many dollars fits into a stock, how many dollars fits into an ounce of gold, how many dollars fit into a barrel of oil, how many dollars fit into a Bitcoin, right? And so the dollar is the denominator, the asset is the numerator, the thing that we're actually like holding, and we're saying, what is it worth in this currency? Okay, regardless of what the denominator is, it does not affect the numerator. And so what happens is we earn our income denominated in US dollars, right? Then traditionally people save their money, their currency, right? I have to even catch myself still. They save their currency denominated in US dollars, and then we invest our currency denominated in US dollars. What do you think a stock is? Okay, I sold stocks. A stock is not anything. When I own a stock, I don't actually own Apple. I can't go in there and tell them what to do. I can't hire people. I can't fire people. I can't suggest things at their next product meeting. I'm basically, it's a token. It's saying, hey, you own invisible shares of a company. You can sell them, and that's about it. Maybe we'll pay you a dividend or a profit. Maybe we won't. We can't guarantee you anything, but that share of stock is denominated in US dollar. And so if the US dollar were to crash, that Apple stock's not worth jack. Nobody's going to take it because it's going to go down in price. No one's going to want the Apple stock because the dollar crashed. So this problem is with currency, it's a medium of exchange. And when we compare currency to money, right, this is the big part we've got to start with. Currency versus money. Money can be a medium of exchange, but primarily money is a store of value. It is a store of value. This is the big differentiator here, and this is what we're going to really focus on during our course tonight. Store of value, right? Now, this was kind of a viewpoint shift I had to have. So who's ever heard of inflation? Right, inflation, a modern definition of inflation. Actually, let's look it up really quick. So I want to see actually what they're pushing these days, because the government and the Federal Reserve Bank don't really like to talk about the concept of inflation. So let's see what they're telling us inflation means today. Inflation definition, the general increase in prices and fall in purchasing value of money. All right, not a great definition. So inflation, they're saying, is the general increase in prices, which is kind of what I was thinking they would say. Inflation, we look around us and we'll see, okay, gas went up, that must mean inflation, right? The price of bread went up, that must mean inflation, right? A house costs more than it did, 30 years ago, that must mean inflation. A postage stamp costs more than it did before, that must mean inflation. As a financial advisor, I was taught prices were increasing. Prices were increasing. For some reason, that's a normal thing, and so that's inflation. Well, think about it. How can a loaf of bread be more expensive than it was 30 years ago? The bread's not better, okay? It's actually cheaper to manufacture. It didn't get more valuable. Bread spoils over time. So how can we possibly say that the price went up when none of the components of bread, none of it got more valuable, right? We can't. Same thing with a house. Let's say a house. How can we possibly say a house is worth more 30 years later than it was 30 years ago? The boards are dilapidated. It's rusting. It's probably got termites. The roof needs to be replaced. So how can we honestly say that that house is worth more money? We can't, right? So what's really happening is what I had to look at. And so instead of prices going up with inflation equals the dollar losing value, right? We just talked about this. We said, okay, back in the day, we bartered, then we had to create a medium of exchange. We created this coupon system that all of us agreed on was valuable. But let's say we start adding more and more coupons. Okay, and all of a sudden, the more coupons there are, the less they're all worth because it dilutes the value. It's just like my coffee. What happens to my coffee if I dump water in it, right? It becomes less coffee, more water. I don't want to drink it anymore. It loses its value. I'm not going to pay as much money for a good cup of coffee versus this watered down cup of coffee. So as we add more currency, more dollars into the system, the existing dollars lose purchasing power, lose value. And so when we start bartering, people are like, hey, that dollar, it doesn't buy the same thing as it used to. So I need more of them when you buy the loaf of bread for me. I need more of them for my house because they don't buy the same things they used to. Now, that's a very different thing than prices went up. Prices didn't go up. The purchasing power of the dollar went down, which means the dollar actually lost its value. Right? We have price. Price is what things cost. Right? Price equals cost. Okay, this is what I pay. Then we have value equals what something is worth. Okay, this is what I get. What I pay versus what I get. We've all paid too much money for a bad deal before, right? We paid a high price for very little value. We've also done the opposite. We got a lot of value for a very little price. So we can agree that there's a difference between those two things. But what the modern monetary theorists have done, meaning the new school behind how money works and the government and the economy, they've tried to mix these things. They've just tried to say, no, price is value. Well, they're not. And the reason that they're not is because something can cost a number, but it doesn't mean I get that. Right? Now, how does this relate to savings? Because today we're talking about gold and life insurance. Why are we talking about price and value and inflation and dollars? Well, think about this. We just said, when I do this triangle of wealth thing, right? The triangle of wealth is earn, save, and invest, right? If I'm earning in US dollars, and then I am saving in US dollars, and then I'm also investing in US dollar denominated assets that have no other value than what they're worth in US dollars, what happens when these dollars start going down in value? When they start becoming worth less and less and less and less and less over time? Okay, on the earning front, it means I work harder and harder and harder for less money, even though the numbers might look bigger. My purchasing power goes down, and so it's like running on a treadmill that never stops. It just continues going faster. Right? I can run faster, but at a certain point, it's like, dude, this is exhausting. Now, what about when I'm saving? What happens when I'm saving in something that's going down in value? Yeah, I might be adding more digits to my bank account. I might be putting more dollars away, but those dollars buy less things. And so when it comes time to transact, yeah, I saved a lot of money or I saved a lot of currency, but those things don't actually buy the same thing they did. And so as time goes on, it buys less and less. What about when I invest in things that are dollar denominated? Okay, this is the stock market. The government can print money. The central bank can print money, and they can artificially make me feel like I have more in assets when really I don't. Right? So this triangle of wealth is earn, save, and invest, but we cannot just do it in dollars. Okay, currency was never intended to be an investment or a store of value. It never was. Right? And here's the history behind this. We go from 1933. We're going to put one right here at 1971. And then we've got one here at 2021. This is now, right? So basically in 1933, gold in the United States of America was outlawed. It was made illegal to own gold. Franklin Roosevelt said, hey, if you own gold, it's a crime. You have to turn it in, and you're not allowed to own gold. And the government and the central banks are the only ones that are. Private citizens can't. Okay, prior to this date, everyone owned gold. Okay, our money system was actually tied to gold, right? So when you had a dollar, you would take that dollar and it would actually be backed by gold. And you could go to a bank and say, hey, I would like to exchange my dollar for the gold that it's backed by. And they would give it to you because it was there and that was our system, right? And so what we did is we had earning in dollars, but those dollars were tied to gold. And so when we were exchanging, there's actually something like meaningful there. If I was exchanging with you, you're like, okay, he's giving me dollars. At least I can get the gold. The gold has value. The gold has had value for 6,000 years. So in 1933, they pull us off that system. And then what they do is they actually start reducing the amount of gold behind the dollar. They say no one's allowed to own gold anymore. And then we're going to add a gradient slowly reduce the amount of gold that backs each dollar. And this happened through 1971. In 1971, they pulled the dollar off the gold standard, right? So we're off gold standard, meaning the dollar was no longer backed by any gold whatsoever. And here we have something called fiat currency. Okay, the word fiat means by declaration, right? By declaration. So we have a currency that is used because the government said so. We have a currency that has to be accepted because the government said so. Not because it's backed by gold and not because it's worth anything, because the government said so. Think about that. That's not valuable, right? Like it's kind of like when you were a kid, if your parents ever did something that didn't make sense and you're like, Mom, Dad, why don't we do it this way? Why do we do it this way? And they say, because I said so, or because I'm the parent. I always hated that. I was like, that's not an answer, man. I know you're my dad and I love you and stuff, but I'm not stupid. I want to know why we do things. Right? So we have the US dollar now in 2021, which is a fiat currency. It actually has no value. The only value that it has is the fact that the government said it has value. Okay, so if I'm saving in this and it's going down in value, now historically, the US dollar loses about 5% per year. So it goes down in value by about a 5% annual rate of depreciation. This is probably going to accelerate because we just printed trillions of dollars in the last 12 months, right? So if I'm saving in dollars, I'm actually losing 5% every year. It's kind of like paying 5% interest on every single dollar that I earn because I'm losing that purchasing power. Okay, so when we do this earn, save, invest thing, and I'm kind of laying out the runway here, we earn in currency. Doesn't matter what the currency is. It can be US dollars, it can be cryptocurrency, it can be wampum. I don't care. When I earn, I want to earn something that I know is exchangeable, right? So I'm earning in currency. It doesn't matter what that currency is. Okay. We save in money, right? So if I'm saving in money, what does that mean? It means I'm saving in something that has a store of value. We're going to talk about that in a second. And then I invest in assets, right? This is all about particle flow. The particle of up here, the value, right? I have value, I have work, I have production. This particle then turns into currency. So my work turns into currency, the currency turns into money, the money turns into assets, right? And then those assets should spit out more currency. They pay me more income and it just continues and repeats, right? Now, if I look at this from that standpoint, what am I really accomplishing if the particle flow never changes, if it never converts? If I earn in currency and the currency turns into more currency, when I'm saving, it's the same thing. And then I invested and it's the same currency that I earned and saved from the get-go. Right? If this was a business, that wouldn't work. I couldn't say the product in division 1 was the same as division 2, and then division 3 it was the same, and 4 and 5 and so on, and it never changed. There'd be no value there. The only value that exists is the change in the actual, intrinsic value or the appearance of or the utility of whatever particle I'm running through the system. So this has to go currency, money, assets. And if it doesn't, there's not actually value being produced, especially if I'm leaving it all in currency, because the currency goes down in value. We tracking? So what do we do? What do we do here to save? What is our store of value? Right, that's what we're talking about tonight. I have 2 or 3 of them that I really like. Okay. And again, the purpose of saving is not for a rainy day. Okay, the purpose of saving is not for an emergency. The purpose of saving is to invest. Right? So we talk about, first we get out of debt, then we get solvent, meaning that we own more than we owe, we earn more than we spend, and then our risks our rewards are greater than our risks. That's our definition of solvency. Own more than I owe, earn more than I spend, rewards greater than risks. Right? At that point, now it's time to start investing. And so when I'm saving, I'm storing up until it's time to invest, whether that be into, whatever asset it might be, stocks, bonds, real estate, private lending. There's tons of them out there, but I have to build up enough money to actually do one. right? So where do I store my value? I like to store my value in gold and silver. And I like to store my value in life insurance. Okay, these are my two favorite ones. Now there are other ones, but I want to talk about why these are my two favorites. So again, first things first is the purpose of saving is to invest in the future. We just talked about particle flow. We have to go from currency to money to assets, right? So there's something about quickly making that conversion happen. The faster I can get those particles moving and converting, the more expansive my wealth gets, right? So the quicker I can take income and turn it into money, that's actually going to help me. That's called velocity. It's going very quickly. The more quickly I can take my money and turn that into assets, that's going to help me. I've got velocity. Okay. The more quickly I can take my assets and have them generate more income, that's going to help me. That has velocity. In an economy, there's something called monetary velocity, which means how fast money moves. When money moves quick, the economy booms, right? Think about pre-COVID, right? Right? Things were pumping and rocking like normal, right? We were going to restaurants, we were going to movie theaters, we were buying cars. The economy was doing great because money was moving quickly. They were flowing and converting, and it was going back and forth and all around. COVID happens, boom, everything halts, people stay at home, people stop buying, and we actually had an all-time high in savings rate, but the money stopped flowing, and so the economy started to suffer because the particle flow slowed down, right? That's called macroeconomics, big picture. Microeconomics, small picture, means my household, right? So I don't really care what happens out there. I care about what happens here. So I can put myself in a boom by making the currency happen quickly, changing the currency into money very quickly, and then changing the money into assets very quickly and having that reproduce more income very quickly. Or I can send myself into a personal recession or depression by moving really slowly at earning income. And then when it comes time to take the income and turn it into money, doing that really slowly. And then when it comes time to take the money and turn that into assets, moving really slowly on that as well. And then when it comes time to have the assets produce more income, moving really slow on that. And if I really slow that down, I'll go broke even though I'm doing the right things. You see that? So with gold and silver, the two reasons I like them is they're very liquid. Liquid means I can move them around easily. I can take gold, I can buy it, instantly sell it, right? Life insurance, I can put money in, I can borrow against it within a couple of days. I can borrow, pull that money out, put it in my bank account and go invest with it. So speed is a major component with each of these. Okay, other stores of value, for example, real estate. I could buy land. Okay, land is a store of value, but it's not liquid, right? I can't be like, hey, I have an acre and I need to go turn it into something else, right? I would have to go to the bank. I would have to take out a line of credit against it. There's going to be probably, a several week or several month process to do that. And that's not fast. I'm not saying don't own land, but I'm saying that's why I prefer these. Same thing, let's say with oil, right? How the hell am I going to move a barrel of oil around? Right? So there's something to be said for speed. Both of these feature this, right? Speed, liquidity are offering me similar benefits. Now, I want to talk about the differences between the two, right? So the first thing I'm going to speak to here is track record. And I'm not going to talk about these as a currency because gold and silver in the past have been used as a currency. Like I mentioned, life insurance has never been used as a currency. So I'm not going to say, hey, this is a currency and it's better because of that reason. We're talking about just the store of value component. When I earn currency and I put it into one of these assets, converting the currency now into gold and silver or into life insurance, what are the benefits as far as, like helping me store that value until I'm ready to invest, right? So the first one I want to talk about is track record. So gold wins on track record. Gold has a 6,000-year track record. Silver does too. Silver is a byproduct of actually the creation of gold in the refining process. So when it comes to track record, like gold is like bar none, like it's the number one asset from that standpoint. It's got the longest track record. Like if you took gold, I talked about this previously, if you took gold and you went into like the Amazon desert, in the middle of nowhere, someone that's never seen gold and you show it to them, they would know it's valuable, even though they didn't know what it was. Even though they didn't know that our central bank has 80% of the reserves in it. right? And so from a track record standpoint, I like gold a lot. Now, life insurance has, several hundred years, we'll say 200-year track record. Okay, not 6,000, but still really good. And I want to show this as a comparable magnitude. Your 401k plan only has about a 40 or 50-year track record. Your cryptocurrency has a 10-year or less track record, right? Your stocks, they have probably, maybe 80 to 100-year track record. Your mutual funds have, only about a 80-year track record. The central banking system, when you put money with Chase Bank and Wells Fargo, the track record is only as strong as that bank has been around, right? So if you bank with a new bank, you might only have a 10, 15, 20-year track record of where you store your money, where you store your currency. Like big picture, central banking itself, like the banking system as we know it, has only been around since 1913, right? So that's 108-year track record. So comparing all the other places, like if I put my currency into a bank account, life insurance is twice as long of a track record. Gold, I don't even know the math on that. That's ridiculous. I think it's like 600 times longer than the bank has been around, right? If I put it in the 401k, it's only been around since 1979, 1980. So they're giving me maybe a 40, 45-year track record, right? Life insurance, we've got a 5 times better track record than that. If I put it in my individual retirement account, that thing's only been around since the 70s and the 90s, right? The traditional IRA, the pre-tax retirement account is in the 70s. The Roth IRA, the tax-free retirement, it came out in the 90s. So I'm looking at a track record on the Roth that's younger than I am, right? So comparing track record on these are better than all the alternatives, but I like gold better on a track record standpoint because of the fact that it's been around that long, right? Now, we also have to look at, when I look at storing value, I also look at safety. One of the number one rules, right, of losing money, or of investing money, not losing money. One of the number one rules of investing money is don't lose, right? So what does the safety or the downside protection look like on these? Now, this is something we've got to change our viewpoint on, right? So there's price and that. Gold is denominated in dollars if we're buying it in the United States of America, right? So if I buy an ounce of gold, it's going to sell for, today I think 770 some odd dollars per ounce. That doesn't mean gold is worth 1770 an ounce, right? Gold is its own numerator, meaning an ounce of gold will always be an ounce of gold. So from a safety standpoint, if we're talking about it from a real true safety standpoint, gold has zero downside because unless someone kills me and takes it from me, it's always going to be an ounce of gold, right? That's called intrinsic value, right? So from a safety standpoint, we're talking value, it's very different. But right here, really quickly, we're going to talk about price, because the idea is we're taking currency, putting it into money, then putting it into assets. All of that does ultimately have to happen to US dollar. And so if I'm doing that over a very quick cycle, it does matter what the dollar prices are, right? So on safety, gold on average can lose about 15% in, right? Sorry, not value, price. Okay, gold can lose about 15% on price. This is called a standard deviation. So the annual average return for gold is about 8%, meaning any given year, I'm going to average about an 8% return on my investment if I buy gold, right? But it's not a steady 8. It's going to go up and down and up and down and up and down. And it's going to average out at 8. And so a standard deviation means how far away from 8 does it go, whether that's on the upside or the downside, right? Standard meaning it's normal for it to go in that range. Deviation meaning a movement away from that price point. And so a standard deviation on gold would be 15%, right? 15% is what I could lose. Now it can go down worse than that. There's been 30% losses in gold. It can go down a hell of a lot more than that. But when we average out all of the volatility, it's about a 15% that I would expect on average, right? Life insurance, 0. I cannot lose money in life insurance. It's impossible. Number one, every single dollar I have is actually backed up by the company, the life insurance company that I have the policy with. Number two, they're contractually obligated to deliver that to me. So they legally have to have it in reserves. They do have it in reserves. If you look at Mass Mutual and Guardian and New York Life and some of the top companies we work with, the total balance sheet of those companies, when you take their assets minus their liabilities, they're as wealthy as countries. Like I think Mass Mutual, New York Life, their net worth individually, like let's take Mass Mutual, for example, is larger than the country of Kuwait, right? So we're not playing with like some tiny little company. These are giants that have been around, the Great Depression, the Civil War, the tech bubble, the mortgage crisis, 2020. Like they've been around through all of these and they've still come out strong. And so they're able to guarantee that, Jared, if you put money in life insurance, you will not lose. A, because we actually have the money there. B, because we have, hundreds and hundreds of billions of dollars in assets and tens of billions of dollars in reserves. And C, we're insured. So if you do go broke, the government bails it out anyways at the state level, not the federal level. It's called the State Guarantee Agency, right? So from a safety standpoint, when we're talking price, life insurance wins. Okay. And so here's my thought process here. If I'm saving my currency in life insurance, this is A, for my reserves, meaning this is money that I don't plan on investing initially. I'm building up maybe my 6-month reserves. And so this is where I want it to be there. I don't care if it doesn't make as much, but if it doesn't lose, that's the entire purpose, right? This is also maybe for shorter term transactions, right? So life insurance over the long term, it's going to, and we can go ahead and jump into growth, right? Right, life insurance over the long term, it's going to give me an annual growth rate of about 3 to 5% tax-free. So 3 to 5% tax-free. We're looking at gold. Gold is going to give me about an 8 to 10%. So over the long term, all day, gold is 8 to 10%. That's awesome. I love that. I would rather have 8 to 10 than 3 to 5, right? But on the short term, I could put $100 in today and tomorrow it's only worth 85 bucks. And so what if tomorrow I did need to convert it into assets? That's where gold poses a problem. That's where life insurance poses the solution. Life insurance says, hey, you put in $100, it's going to be $100 tomorrow. It cannot go down. Gold saying, hey, we don't know. Market could go down or up. That's up to the market. And you have to kind of just go with whatever you get. So from a growth standpoint, gold wins, right? But from a safety standpoint, life insurance wins. So both of them, as you can see, they have different things that we use them for. The other one that I want to talk about is the tax treatment. Right, I'm just going to put tax here. That's a little bit easier. So life insurance is protected from income tax. Okay, section 7702 of the Internal Revenue Code, it talks about how a life insurance policy, it grows tax deferred inside of the cash value, meaning that if I were to put money in and pull it out, it's not taxable while it's in there. And then it also says that you can take loans against the life insurance policy and that's tax free, right? So this has 0 tax liability innately, like it's designed that way. This is why corporations use life insurance, right? So we already know life insurance wins from a tax standpoint. Gold, you do pay capital gains tax, right? Now this is in and of itself. You can get lines of credit and take loans against gold. And if you take a loan against gold, it is tax-free as well, but that's not built into the gold, right? You have to have a certain amount of gold or a certain amount of silver to be able to do that. You have to qualify. There's an underwriting process, just like any loan. And so that's why on the taxability, you can effectively achieve the same thing with gold, but it's not built into the gold. The tax-free thing, that is built into the life insurance policy. The entire design is based on that concept, right? So when I'm looking at protection, like here's the other thing. Gold is only as safe from the government as I can protect it personally, right? So, I could do the loans and protect myself from taxes, but if the government seized the gold again, let's say that, and I don't think they will, but let's say that 1933 happens again, they're like, hey, gold's illegal. At the end of the day, I've either got to hide it, I've got to fight them, or I've got to give it to them, right? And it's a physical thing. They can come take it from me. So there's a difference there with life insurance. Life insurance is what's called a unilateral contract. With contracts, there are different parties, different groups involved, right? And so a bilateral contract is a contract between two parties, party A and party B. They both have the ability to change the contract, right? Unilateral means there are two parties, but only one of them can do anything with the contract. And life insurance is unilateral, meaning that once a life insurance policy is issued, the only party that has any way to change that contract is the person that bought the life insurance, right? The government can't change it. The insurance company can't change it. The IRS can't touch it. It's protected from bankruptcy. It's protected from lawsuits. It's protected from creditors. Okay, so the other thing that I want to hit here is protection, right? Protection. This is different than safety. Safety, we covered this in terms of like downside returns. Protection, life insurance is basically inaccessible. Like if I got sued, I could literally tell them, yeah, I have a life insurance policy. You can't touch it, right? If I had the IRS coming after me, I could say, hey, I have a life insurance policy. Yes, but you can't touch it. The difference between that and gold is self-protection. If I got sued, I couldn't tell them about the gold because I wouldn't want them to know, right? If I had the IRS come after me, like if they found out I had gold, they could seize the gold. That's all. I'm done. Like I have to give it to them. With life insurance, I can show it to them and put it in their face and they cannot do a thing about it because it's a unilateral contract. They can't legally do anything with it, and I'm protected because of that. Okay, so in an environment where I'm looking at protection, I like life insurance better from that standpoint, right? And then basically the other thing too is the exchangeability, right? How exchangeable are these things? And this is one where life insurance, you know, gets a little bit of a bad rap, and it's not really true, right? So I buy life insurance and people have this attitude of like, hey, I own life insurance. What the hell can I do with it? Okay, I can borrow against it. I can do a lot of things. I can sell it as an investment. I can give it back to the insurance company. So they're both very exchangeable, and that exchange can just as quickly on either side, right? So if I own gold, I can go back on the market and I can sell it. That's instant. It might take a couple of days to process the transaction and a couple of days to ship it, right? With life insurance, right? If I want to exchange the life insurance for something else, I can do that via loan, or I can do what's called a life settlement. I can go to an investor and say, hey, I've been paying the premium on this. I don't want it anymore. And so I want to sell it to you. Will you pay me, you know, 2, 3, 4 times what my cash value is worth? Right. And the investor actually will. There's actually a market for these. And so I could actually sell the life insurance to the investor, get out of the policy entirely. It's now theirs, and I get cash instead. And then I can go buy real estate or whatever it might be. Right. Or I can go back to the insurance company. I have something called a cash surrender value. The cash surrender value means the insurance company is always willing to buy me out of my life insurance policy. And so I can go right to them and say, hey, I want to surrender my policy and give it back to you. And I want the value that you would give me in return for that. And that can happen within days or weeks. Right. So both of these are also very exchangeable. And so really, like, one is not better than the other. And I want to drive this home. They're different. They have different purposes, totally different purposes, right? And totally different ways and times that I would use them. So if I'm brand new in finance, meaning I'm on like phase 0 of my blueprint and, you know, I'm just getting started, I actually tell people start first with gold and silver. Okay, they achieve different things. When I'm brand new at this, like I said, we earn in currency, we save in currency, we invest in currency. We have to get out of currency. How can I learn about something if I have no reality on it? I have total lack of math because it's just digits, right? So by getting gold and silver first, we have a subscription where we actually send clients gold and silver every month, as low as $17, and you can be getting silver, but I actually have money in my hands. Okay, it hits different when I'm actually holding it and I see it and it's there, right? That's different than theoretical numbers on a screen or on a credit card balance or even paper, right? Or a debit or credit card. When I'm actually having physical gold and silver show up, the first time I ever bought gold and silver and it showed up and I held the silver in my hand, that was the game changer. Okay, this is this idea of people tend to keep things that are valuable and get rid of the things that aren't. The reason why people overspend is because they internally know that currency has no worth, right? But when I have gold, I'm not going to spend it. I'm going to keep it. And so I tell people start here, A, because it builds the habit of a forced savings plan, but B, because it's real money and it's tangible. And I believe it's called Gresham's law. Don't quote me on this, but I believe it's Gresham's law that people will, you know, naturally they'll keep the things that are scarce. They'll save them and keep them, and they'll get rid of the things that are plentiful. Right. So in the United States, we've printed off trillions of dollars in the last 12 months. Dollars are plentiful. We need to get rid of them. Gold and silver are scarce. We need to keep them. Right. And so this is the first step. Now, when someone is past that, the next thing we add is life insurance. Okay. Typically, this is going to be initially starting out for either paying off debt or building reserves. Okay, life insurance is excellent for that. If I'm paying off debt, I need to have no chance of loss. I need to have the ability to borrow against the policy and use that to pay off my debt. If I'm building reserves, same thing. I need to be able to get 6 months of reserves set aside into something that has no chance of loss, only chance for gain, that's totally protected, right? So the life insurance comes in. Once I have that, let's say I'm out of debt, right? I have my reserves. Now I go back to gold and silver. Okay, and I posted today that I own more gold and silver than life insurance. And the reason why is right here. I initially start with gold and silver. I actually initially did start with gold and silver. Then I do the life insurance and I get rid of all of my debt. Now I have all this extra cash. I fund my 6 months reserves, right? This is good to go. Now I have all this extra cash. Like when I'm debt free, how much money do I have now every month that used to go to payments that doesn't? Okay, and so here I'm going to take that and I'm going to start building up my gold and silver. Okay, so I'm going to start building up my gold and silver, and that's actually why I own more gold and silver than life insurance, is because the life insurance did what it needed to do. It got me out of debt. It built up my reserves. I still do fund my policy every year, right? But there's a certain amount that I can put into it. Beyond that amount, my MEC limit, I can't put more into my policy, and so everything else for me goes into my gold and silver. So I stack that up and I borrow against it. Now later on, the life insurance comes back when we get into, needing estate protection and asset protection. Right? We're going to bring the life insurance back into the picture. Right? This is life insurance again. Right? So there's never going to be, and this is where it's so different than traditional finances. We're taught that finances are very black and white and binary, and it's you always put the money in here and you always give it to the bank and you always give it to the 401k and you should always start early and always do this. We're saying no, no, no. At different times, you're going to need to do different things because each of these tools has a different function. And so it's about where am I at, what thing am I doing, and what function am I trying to cause? Right. And ultimately, these are both great assets. Like I own both. I love both of them. If I had to pick one of them over the other one, I don't think I could because they do such different things, even though they're both a store of value. Right? They're both a store of value, but they have different functions. And this, this is compared to what I used to do, which is what the average person does. I just save my currency in currency. I put it in the bank, let it sit there. It goes down in value over time. I didn't know because I never get a bill in the mail saying, "Hey, Jerry, you owe inflation." It just buys less next time I go to use it. But if my numbers in my account look like they say more, I don't know the difference. Right. So it's so important to understand this. And again, it comes down to, the very basics of what we went over at the beginning of this class today, which is, currency and money, the difference between price inflation and currency devaluation, and then the difference between price and value, right? And if I can keep those 6 points organized and understand them, it makes things so much more simple, right? So guys, what I want to do is I want to open this up for some questions. I know we have some on Facebook, we have some on Zoom. If you have questions, drop them in the comments. If you're on Facebook, I'll answer them here verbally. If you're on Zoom, we'll actually go live together and have a conversation and answer your question on the live feature. But let me go ahead and check our Facebook questions first. And again, if you have questions, put them in the comments and we'll go over those here now. Chad has Chad just says Florida. I'm Ron Burgundy. Chad, we do live in Florida now. That is correct. What's up, Ben? Todd, good to see you. David, good to see you. Josue says reduced lunch over here. Josue was a free lunch kid in high school too. It was cool until high school. Like in middle school, people were like, "Oh, you get free lunch," and then in high school, it's like, I don't want anyone to know I get free lunch. Angie is here. Good to see you, Angie. Ryan is here. We got the whole Ambrosetti clan. Good to see you all. Justin Goff, good to see you. Justin says he's at a soccer tournament in Chicago. That sounds fun. Justin in Chicago. That sounds like an interesting time. All right, let me see what we have on Zoom. Let me go ahead and bring up our Zoom questions. All right, David has a question. Let me bring David on live here. All right, we should have David here. If he's got the microphone. David, can you hear me? Yeah, I can't actually hear David. I don't think David's mic is working. All right, so let me just read David's question instead then. David's question is, he says, so is selling real estate now at an inflated rate and taking that money and turning it into currency, is that a good idea? It can be, right? So it depends. So the first thing you got to look at is, again, when we're taking an asset like real estate, if you're treating it as a store of value and we're saying, okay, great, I'm going to now convert that to an asset, we want to have the asset figured out first, right? So we never want to sell out of a store of value without knowing where it's going to go next, because then that particle just floats, right? It has to be A to B. We want to go from here to here. So if I have real estate as a store of value, and I'm saying, hey, let me sell this and do a private lending deal, for example, that's going to generate me passive income. Boom, I know where it's going to go when I sell it. A couple things to think about there are tax consequences. If I sell it, what are the capital gains taxes going to be? With real estate, you can borrow against it. So you don't necessarily have to sell. If I owned good real estate, I personally wouldn't sell if I could put a line of credit on it. And so that's where we use the replace your mortgage concept of taking a line of credit, using that to borrow against the equity in that real estate. And then we can put the equity to work by investing it, but actually keep the land, and that land can still appreciate. And I think that it still will ultimately. So that's what I would say there. Uh, okay, David said I did answer that earlier anyways. All right, so Nano has a question. Let me bring Nano on live here.
What's going on, Jerry?
Hey, Nano, I haven't seen you like an hour, man.
I know, right? So question for you is, when would I pay capital gains on the gold? Just by owning it or when I actually sell it?
Yeah, so just when you sell it. So when you own gold, a capital gain, it has to be realized. So there's what's called an unrealized capital gain, which means the price went up, but I didn't sell it and actually take the money. Realized means that I did sell it and I did take the money. At this point in time, the IRS cannot tax an unrealized capital gain. They can only tax it when I sell it. So again, capital gain, capital meaning money, gain meaning it went up. So I actually have to get rid of it at a profit, take the profit, and then I owe the taxes at that point.
So the goal would never be to sell the gold then, just use the line of credit against it.
Yeah, I'll never sell it, just use it against it, use the line of credit. And if you ever do sell it, like there are proactive ways to get rid of capital gains taxes. Our CPA firm does that. But with gold, like I wouldn't ever want to get rid of it. It just continues to go up into value as money becomes less and less valuable. Okay, Nano got Gresham's law. He said Gresham's law is a monetary principle stating that bad money drives out good. Gresham's law says that legally undervalued currency will tend to drive legally undervalued currency out of circulation. Logically, people will choose to transact business using bad money and hold balances of good money because good money has the potential to be worth more than its face value. Yeah, and so that's Gresham's law. I don't know who Gresham is. It's a complicated way of saying we keep the good shit and get rid of the bad shit, right? So when we know money is not worth something, boom, we get rid of it. We keep the stuff we know is worth something. And so dollars are worth nothing. People know that. That's actually why people are paycheck to paycheck. They intrinsically and internally know the dollar is worth nothing. Why would I save it? Okay, what they don't know is they should be saving. But I want to address two things that I said before. The idea that savers are losers. Savers aren't losers, right? Savers are future investors. Those that save in currency are losers, right? Because the currency goes down in value. But if I save in gold, if I save in silver, if I save in life insurance, if I save in real estate, I'm not a loser. I'm actually going to be like better off at the end. The other thing is the idea that cash is trash. It's not trash, it's just debt. If you look at your dollar bills, it actually says it is debt, which means it has an interest rate. We pay that via inflation. And so it does go down in value and it does cost us to own currency. And so it's important to take these really cool sounding marketing phrases and ask ourselves, like, to what degree is that true? Sometimes it sounds really cool, but it's not actually true in application. And a lot of my problems as a young person doing money was taking these really cool sounding ideas that I heard from all these marketing gurus about finances and trying to apply them and then figuring out that they didn't work and I didn't have all the data and they weren't correct and that there was something that was maybe missing a piece of context. And so those are all things that I would say to think about. Okay, Nilufar has a question. I can't go live, but I had a question regarding inflation. If I save money in a sacred account, isn't it still losing money unless I invest? So that's a great question. It's kind of like this. So if I have a river, right? So let's say I have a river. Current is going this way, right? Current is flowing this way. And I have my dollars and I'm trying to get them to go this way, right? If I have just a US dollar, it's got no swimming power. It's got no motor, no engine, no rudders, no nothing. And so it's just going to go down the river with the current, right? And that's currency comes from current. It's a flow. If I have life insurance, right, I have a motor that is tax-free, right? So it's actually saving me by avoiding taxes. And then it's also giving me a growth rate of 3 to 5%. And so it's kind of like this dollar is propelling at a 3 to 5% rate, plus whatever my taxable equivalent would be, right? So 5% in a life insurance policy anywhere else is actually more because I don't have to pay taxes on it, right? If I'm in a 25% tax bracket, for example, if I make 5% and I'm in a 25% tax bracket, if I made 5% in a bank and I have to pay 25% taxes, that means that I only actually keep 3.75% because I've got to pay 25% tax on it. Life insurance, I pay zero tax, right? So it's called a taxable equivalent rate. So there's a value there. So we can take a calculation of what this rate is, and that is what's propelling me against the current, right? Now, life insurance is constant, meaning it's never going to stop propelling against the current. Gold, on the other hand, is going to give me 8 to 10% on average, right? So it's got a stronger kick in it, but it also can lose. So what that would look like is in the sense of a current, at various intervals, the gold would stop moving and fall backwards, and I would lose ground, right? So life insurance and gold, and it doesn't matter what the value store is, there still is inflation, and that still is a current that we're trying to swim against, right? And obviously, the greater the rate of growth, the more we're getting against that current, but also risk comes into play, taxes come into play as things that can slow us down as well. And so to answer your question, yes, you still have inflation. You are out earning it to a degree, and same thing with gold and silver and the other ones. Andre says, plus the death benefit is going up more as you put the cash in the sacred account, which is true. When you die, your beneficiaries do get the money. With whole life insurance, like the sacred account, that's guaranteed to happen. So it will be there and they will get it. And so there's a rate of growth inside that death benefit too, which also outpaces inflation for your future generations. Great question, though. I love that question. Let's see what other questions we have here on Zoom. All right, Nano has another question. Let me bring him on here and answer his question here.
Hey, Jerry.
Hey, Nano, you had another question.
Yeah. Why do you own more gold and silver than life insurance?
Yeah, so I kind of covered that. So the first thing being is the life insurance is, primarily when I really super funded it was getting out of debt, building up reserves. Once that was done, I have my MEC limit. And so I can only put so much into the life insurance. And then once I max that limit out, I've got to put that money somewhere else. And so if I've maxed out my MEC limit, the rest of that for me naturally goes into gold and silver. I'm also more aggressive, right? So I like owning gold and silver. I like owning life insurance. I also like the higher return better. And so I'm solvent. I've got plenty of life insurance, plenty of gold and silver. I'm at the point now where I can kind of pick and choose where I want the money to go to. I'm okay with the volatility. And so naturally, I would choose to put more into the life insurance or into the gold and silver than the life insurance. Now, granted, if you go back to our three tiers that we talked about, maybe a month or two ago, life insurance is tier 1, gold is tier 2. And anytime I borrow against my gold, I do need to put more money into the life insurance. I put a 10% reserve ratio in that life insurance. just to basically protect my risk against that loan I've now taken on the gold. So that would be, for me, my reason. I know other people that are totally different. I know other people that they own more silver. But for me, I like gold, probably first, and then I like the life insurance. And I don't do as much with silver, but that's a different discussion altogether. Okay, we have another question here from Junior. Let me bring him on here. Let me see if we've still got Junior in our feed. Junior or JR? This is one of those moments where I'm either getting your name right or completely butchering it, but we're about to find out. All right, am I speaking with Junior or JR?
It's actually Jeff, but that was
Jeff,
my
okay.
initials.
All right, cool. Well, it's good to talk to you, Jeff. You had a question on our chat here.
Yeah, I was just thinking, I already have permanent life insurance. We're selling our house and renting a house, and so we're going to pay off all our debt and sit on maybe $110,000 of cash that came out of the house. It wasn't a good house to keep as a rental because it had a private septic and well and that kind of thing. But where do you go with that? I got a tiny bit of silver that we've held on to, a few $100s, but is it next step gold? I did read your book, which a month ago, but yeah, anyways, what are your thoughts?
Yeah, so that's a good question. So what I would do here is, if I am Jeff and I'm selling the house and I'm paying off all the debt, if I've got 100 grand, first thing that I'm going to do is I am going to set aside 6 months of reserves in life insurance, right? So this is going to go into my life insurance. Now he mentioned he has a whole life insurance policy already. I would analyze that to make sure A, it's with the right companies, B, it's with the right design, and then C, it's also high early cash value, meaning you get lots of money up front and very little premium costs. And so I'd make sure I have 6 months into something like that. Anything beyond that 6 months, I would do gold, and I would be looking to get at least 35,000 or more, depending on how much I have left after my reserves, right? And I want to borrow against this. I'm going to borrow against the gold. I'm going to take a loan against it, and I'm going to put that into private lending. Okay, that's going to generate passive income for me. And then it's go back to square one, earn the money, save the money, invest the money. But that's what I would look at there. And if you'd like, Jeff, if you get in touch with Nano Aquino, he's in the comments. He can actually do a free consultation with you on, for your situation, what should we do? Because this is, 30 seconds on Zoom. If he can get a lot more context from you, maybe on a Zoom call, and really dive in deep with you, he's able to help you out with, is that the right step and is that the right move for you? All right, just one says, amazing data. I'm excited to increase my earnings in active income, save the fake money, the fiat currency, and real money, preserve my wealth in gold, and protect it with life insurance, all while investing in passive income producing assets. Then repeat the process with monetary velocity until I reach financial freedom. Awesome. Just one has it. All right, looks like we have some questions inside the Q&A feature as well. All right, we have a question from Mark. Let me bring Mark on live here. All right,
Jerry.
we have Mark Perry live. How are you tonight, Mark?
Hi, Jerry. How you doing?
I'm good. Thanks for asking. What's your question?
Yeah, basically, I don't remember what I wrote in there on the Q&A, but I'm at the point where I have, I have a lot of gold and silver, and I'm at the maximum point where I'm risking. I have a lot at my home right now in safes, but I'm at the point where I can't get my homeowner's insurance company to protect it and insure it. They just won't do it. So I'm at the point where I'm paying to vault whatever additional gold and silver that I'm buying with a company that I'm presently dealing with. And so that the cost, it's not a huge cost, but it is a cost of saving the gold and silver in their vault system. So my question is, at what point in the accumulation of gold and silver does it become cost effective to stop accumulating and move it on? And I do have a banking policy also, so I'm just at a crossroads where do I stop buying gold and silver? Do I keep on buying and pay the cost for vaulting it, or what do I move on from that point?
Yeah, so that's a great question. So Mark is saying he owns enough gold where he can't keep it at his house anymore. First things first, Mark, congratulations. That's a very good problem to have. But with that, I would say that in my opinion, you're at the position or in the position where you should be borrowing against the gold. Right? So gold is not something that pays a yield, meaning I don't get an income. When I earn gold, I just get appreciation and I can sell that or not, right? But if I borrow against gold, I can then take the equity or the line of credit that I borrowed and invest that in something that does produce income. And that income will pay for the cost of inflation, or sorry, not the cost of inflation, the cost of storage, the cost of interest on that loan. And so that's what I would say. It sounds like you're probably at that point or near it, or maybe even past it. And so I would look into that. I'm not sure who you're vaulting with as well, but that's another thing to look at is if you have enough, you should be able to start getting discounted vault rates, and that'll drop your price down. Mark, I'd recommend though connecting with Nano Aquino. So we do, storage, we do gold loans, and so that might be an area we can help you out with. I wouldn't stop accumulating, like that's storing value. You're gonna save, we got to save it somewhere. So if you have the life insurance policy, perfect. Continue funding that, make sure that's properly designed. I would still continue buying the gold and silver and just use that borrowing and line of credit feature to be able to give you some yield and cover those costs. Awesome questions here. Let me bring John Moss on here tonight, one of my clients in Alaska. John has a question. All right, we have John live here. How are you tonight, John?
Good. How's it going?
It's going good. What's your question?
So I was just curious of why, we don't hear more about these strategies from other financial, heads instead of, we hear it from you, but we don't, it's not a very common topic that's talked about anymore.
Yeah.
I listen to Robert Kiyosaki, I listen to Grant Cardone, and then the other, talking heads, but we don't get much out of this any longer other than you. So that was my question.
Yeah. So basically John is saying, mainstream, we don't hear about this a lot. And he also mentioned some of the influencers that are kind of on the alternative side, Robert Kiyosaki, Grant Cardone, and it'll kind of hit both of those sides. So first off, the mainstream financial advisors, you have to understand that a financial advisor, and John knows this, I think John's kind of baiting a question he might know the answer to. Financial advisors are a sales and distribution force for Wall Street. The word financial advisor is just a title. It doesn't actually mean anything other than person who sells financial products. So Wall Street doesn't make a fee on anything we talked about tonight, right? If you buy gold, it's not in their bank, right? If you put money in private lending, it's not in one of their funds. They can't make fees on it. And so they have no incentive to have their salespeople know about the stuff we're talking about tonight, because it actually takes food off their table and it reduces their profit margins. Secondarily, if someone becomes financially independent, they don't need government assistance. They don't need welfare. They don't need Social Security. They don't need most of the things that our country provides. And so there's an aspect of the thread of what we might call patriotism or just a healthy government or economy that is at risk when all of us become financially independent, because we don't need that stuff anymore. We start looking at something like income tax and like, what do you actually do for me when I pay my taxes? I don't need any of the stuff you guys do. So there's that aspect to it as well. So there's a lot of incentive to keep it out of the school system, out of the financial advising world, out of the curriculums that are being taught for those reasons. On the influencer side, you'll hear people like Dave Ramsey, or not Dave Ramsey. He would be a terrible person to listen to on this stuff. The Robert Kiyosaki's, the the Grant Cardones, the Mike Maloney's, and Mike is maybe not as much in this pool. Those guys are mostly marketers. Right? So not saying what they're saying is not true, but they're giving blanket advice and they're giving pieces and components of what they did, not the full picture. And so it's a lot different than like for working with me, for example. Yes, I market, but my job in my business actually is to help you with your finances. And so like Robert Kiyosaki will specifically say, hey, we never do advice. It's always education. You can't get someone from Robert Kiyosaki's team to sit down with you and advise you and help you with your investments, but they will sell you courses and books and videos, right? Same thing with Grant Cardone. And there's nothing wrong with those guys, but realize that yes, they have the lingo and they have the stories and they have the background, but they're not giving you the full directions, right? Like think about like a recipe, they're giving you the sexy picture of the food on the front cover, but you don't get the directions on the back of the box. And so that's the big difference that you might be seeing. And so that's really on the influencer side of things, to answer John's question there. All right, we have a question from Balaz. Let me bring Balaz on here. Lots of good questions on this course tonight. I don't think we actually have Balaz on the feed anymore. All right, so let me go ahead and just read this question then. Balaz asks, hi, life insurance seems to be a dollar denominated asset, isn't it? So that's a great question. So technically everything is denominated in dollars. The question is life insurance numerated in dollars, which the answer to that is no, it is not. You can buy a life insurance policy in any country in the world and it's going to be, numerated in the insurance company's guarantee. Right. And what I mean by that is the life insurance policy might pay out in dollars or euros or yen. At the end of the day, it doesn't matter. In the United States of America, the life insurance industry has undergone 4 currency resets. Okay, meaning the dollar as we knew it went away and a new one came over 4 times. And the life insurance companies say, great, we'll just pay you out in that. So the difference there would be like with a stock. If a stock is denominated US dollar, there's no guarantee behind the stock. With a life insurance policy, there is. The company saying we're guaranteeing to pay you out. And if that denomination changes from dollars to cryptocurrencies to whatever, it doesn't matter. We're going to pay you out, as we promised and as we guaranteed. And then their assets reflect that as well. So good questions there. All right, we have a question here from Bayou. Let me bring Bayou on live here.
Hi, Jared.
Hey, Bayou, how are you doing tonight? Oh, I think we accidentally muted Bayou.
Okay.
All right, you there?
Yeah, I'm here. So my
Awesome.
Hey, so good to see you and hear you. Thank you for all that amazing information. My internet has been a little spotty, but you might have answered this. So basically, Daniel and I are kind of making it so we can live anywhere, like we can kind of, travel. And so we're not like renting one place, not even for a full year. So my thought is, where do I store my gold? And I know you have the answer.
Yes. So, and I do much the same, right? We went to Bayou's in LA where we were. So we did the same, LA to, Florida. Before that, it was Alaska. So if you're constantly on the move, there's a couple different ways you can store gold. If you have smaller amounts, there's something called a diversion safe. And a diversion safe is basically a safe that looks like not a safe. It looks like a dictionary or a Bible or a Coke can or a hairspray bottle. And so you can actually buy these and keep your gold and silver in them. And the average criminal, when they try and rob a house, they stay in, I think, less than 10 minutes. So they're not really like going through and shaking the books and trying to open up your spray bottle cans to see if they're actually diversion safes. So that's a great way to spread out and store with you. Now you can also store offsite. There's something called a depository. We can actually send it to them. They have a vault that's secured, guarded, insured, etc. And so that's where I don't have it in the house. It's just there. And if I want it, I can have them send it to me. So I do both. I keep small amounts with me. I keep them hidden. I use diversion safes. And you can check those out on our websites. They're very inexpensive. And then I also vault them. Like Mark had mentioned, I send them to a depository and that depository will keep it there. That way it's not tied to me. If I want to go to, New Hampshire or Pennsylvania or wherever, my depository, is always going to be the same location, and that's where the gold and silver will be regardless. So good question from Bayou there. Let me see what else we have here for questions. I think we have a couple more on Facebook before we tune out here today. Okay, Adriel Martin says, how would life insurance fare in case of hyperinflation? So life insurance would actually do very well in hyperinflation. If you go back to the 70s, we had very high inflation rates. And so the way that the government combats hyperinflation is they raise interest rates, right? So they try, and hyperinflation means that the currency has gotten so small in value that it's more and more and more and more currency to buy the same things. And so the value went down, the prices go up substantially. And so the way that the government tries to reform that is they raise interest rates to try and slow inflation down. Life insurance is invested in interest rate sensitive instruments. So they do a lot of commercial mortgages, bonds, etc. And so in an environment like that, life insurance would fare very well because the rates would be going up. So life insurance would be yielding more. And then they also invest similar to the way Warren Buffett does. They will buy blue chip equities, private equities. And so in hyperinflation, the equity value artificially spikes on those kind of assets. And so you kind of get the best of both worlds with that. And so that's what I would expect to have happen there. Now, it looks like a couple questions from Adriel here. It seems that life insurance is strongly denominated in currency and would crash along with the dollar. I think we kind of hit that. So again, it's everything is denominated in currency, but the question is, what is it numerated in? So it's not numerated in currency, it's numerated in the promise to pay from the insurance company and that unilateral contract, regardless of what currency it's denominated in. All right, I think that is all of our questions here on Facebook. Let me just double check on Zoom really quick and see if there's any more that we missed. Okay, guys, I think that's it. So we're going to go and tune off. Thank you all for watching. We'll be back next Friday again, 10 p.m. Eastern time. If you watch this and you're not yet a client and you said, hey, this made sense, I got something out of this, continue tuning in, but also get a copy of my new book, Blueprint to Financial Freedom. If you go to jerryfetta.com/B2F, that's the letter B, the number 2, the letter F, you can get a copy of that book. And then if you want to set up a free call with our team, Nano Aquino can reach out to you in the comments, get a call set up with you, answer your questions, and help you out however we can. But guys, that is it for tonight. Thank you for tuning in. Make sure that you share this, and I will see you all next week.